Welcome back to Vantage. I've got a fund manager who focuses on two really big topics, behavioural finance and thematic investing. He's here to talk about a UCITS fund he's launched in June. Let's go take a look. Welcome back to Vantage. Delighted to have Mark Tinker, CIO of Toscafund Hong Kong, back with us in front of the Vantage cameras. Mark, for those who didn't necessarily watch the last video, maybe you could just touch on your own background and what you're doing today.
Right, well thank you, lovely to be here again, nice to see you again. Yeah, so I've basically been in the markets for 35 years or so. I spent the first 20 of those as a sell-side global strategist, and since then I've actually been on the other side of the fence. I've been a global investor with large institutions, and 10 years ago I moved out to Hong Kong, where I was working with active investment managers, and we're developing the business out there. More recently I've set up some businesses on my own, but in particular I'm working with one of the UK's longest running and best respected hedge funds, which is Toscafund. So I'm now the CIO of Toscafund Investment Management in Hong Kong.
So as I understand it, the fund you're running has got two components to it. The one which I think most people are going to be familiar with is the thematic component. So let's start there and understand how you're investing thematically, and then we can get on to the other aspect, which is the behavioural finance.
Of course, yeah. So essentially I've always approached my global investment through a thematic benchmark. Instead of saying, why do I pick a sector, why do I pick a country? I'm trying to invest in the long-running themes that are available in markets. And in this fund, what I've actually decided to do is not to pick individual stocks. I'm trying to capture the theme. So now we have what we refer to as smart beta indices. So there is a global index of robotics, there is a global index of digital security, there is a global index of things obviously like energy and clean energy and so on. So I take a basket of themes that I like, and I'm now able to essentially express that through buying an ETF that tracks one of those indices. Yeah. So what I'm doing here, quite importantly, is I'm taking out the stock-specific risk. I don't have to try and identify the one stock that best captures it. I'm capturing the basket. That makes it a lot easier for me to run because, of course, even if you've only got 20 or 30 stocks, that's a very, very intense process because you're not just looking at the theme then, you're looking at the management, you're looking at their ability to generate on theme and so on. So I've moved away from being a stock picker to essentially investing in themes via large liquid ETFs to put together a portfolio where I'm effectively exposed to the themes I think are running best at that particular time. I don't have to be committed to a single one, and I don't have to be committed to all of them. So it's a different way of effectively doing the same thing.
That's great. So, I mean, to understand that a little bit better, it'd be worth sort of delving a little bit deeper in terms of your understanding of the themes. Maybe we could pick on robotics and automation, which is interesting to us because, our view is that in light of the rising cost inflation they're seeing, you're probably going to see more companies looking at how they can make things more efficiently. What's driving that theme? What makes it interesting to you? And how do you track it? What kind of things do you look for?
Right, thank you. Yes, of course. Well, I mean, robotics and automation is one of my long-term favourite themes. And when I was at my previous job, we actually had a specific robotics and automation thematic fund that I did a lot of work with the team on. And one way of thinking about it is that this is about industrial efficiency. I mean, even today, recently you've had someone like Toyota have just announced that by incorporating aspects of 3D printing, by incorporating aspects of industrial efficiency, they are able to extract huge amounts more profit out of their existing process. So the thing about the automation and robotics part of it is it is an ongoing thing because every manufacturing business is incorporating more and more of this robotics and automation into their processes in order to drive their profitability. So you can look at it from both ends. You can look at it from the people who make the machines, or you can look at it from the people who are using the machines to enhance their productivity. And it isn't just manufacturing cars, it isn't just about robots. It's things like robotic surgery. There's all sorts of elements that come in here, which are some fascinating companies, and obviously over the years I've really got to know the companies, but what I'm doing here is saying, look, I think this is such a powerful theme that I want to capture everybody that is in it, if you see what I mean. But it's, we talked about the fourth industrial revolution, and we talk about, right now we're talking about software and we're talking about computers, etc. But a lot of this is effectively hardware manufacturing using robots to enhance the manufacturing that we understand, improving the quality of everything, improving the efficiency of everything. And as a result, it's a great long-term theme for companies that are involved in it.
Yeah, and does AI sort of feature at all in this theme, or is it separate?
Well, it's kind of connected. I mean, AI is more about, in my view, about improving the productivity of the service sector, whereas this is more about improving the productivity of the manufacturing sector. And in that sense, I think AI is hugely, hugely interesting, but capturing it within a thematic is, particularly at an early stage, is always quite difficult. So they're really right now, when people talk about AI, they're talking about NVIDIA and some software. And how we have to be very careful as thematic investors that we don't just sort of buy into a hype. We actually try and capture the real economic benefits that are coming through.
Okay. So the other aspect, you had hinted on this the last time you were in front of the Vantage cameras, is the behavioural finance aspect of it. Could you explain what it is for a layman and how you're expressing yourself?
Of course. I mean, I think if you think about it this way, I mean, most long-term investors, so most laymen, as you might call them, they are long-term investors. They want to put their money away and they want it to grow, they want it to be in the right part. And in a sense, they often have a value bias. Yeah. And they say, looks great value. And what you're relying on is that other people in the market will recognize the value that you have recognized. And as a long-term investor, you have the time for that to happen. However, one of the things that we need to realize is that there's a medium-term investor and there's a short-term trader who may have very different views than you. So you can sit on the side and wait for your value to be realized, or you can try and understand when there may well be a catalyst. It may come from the medium-term asset allocator, it may come from the short-term trader. But it's part of that process, from where I'm looking at it, is to say, look, okay, well, if we look at the factors that we look at. So part of my fund is looking at themes, the other part looks at factors. And what do I mean by factors? Well, we can think about the fundamental factors. So we've got value. We know there's a return to value over the long term. We can look at things like size. So small companies, small cap companies, operational leverage is more powerful. They tend to deliver returns over time. And we can look at quality. So we know we like cash flows, we like good balance sheets. So all of that fundamental stuff that we focus on as fundamental long-term investors. However, there are other things, like other factors, two other ones. One is called minimum volatility. Now that is about risk management. And what I think we talked about before, you have to understand, I've been in this business for a long time, and the reality is that a lot of people, if not most people operating in the business, are actually managing risk down. Yeah. They're managing your risk down, but they're often managing their risk down. So they don't want to stand out. They want to track an index. So therefore they're not allowed in many cases to have too much volatility. So they want to reduce their volatility. So understanding how an asset allocator is working, he'll buy something not because he likes it, but because he's underweight and it's going up. Or he'll sell it not because he doesn't like it, because he's overweight and it's going down. Yeah. Because they don't want to stand out, because the nail that stands out gets hammered down. And it's just, that is behavioural finance. I'm not criticising it, it's just understand that is a very important part of the way financial markets work. And then you've got the short-term trader, and he's the momentum guy. So basically he wants to buy something that's going up, and he'll buy it with a lot of leverage. And again, as we talked about last time, I call this noise trading, and it's very dominant in areas like FX and commodities, and to some extent parts of the bond market. And why is that? It's because essentially you're 10, 100, 300 times leveraged in terms of some of these FX guys. So basically, you want to put your position on, then you want to make a lot of noise, and you're going to say it's going to move 10%, and when it's moved 1%, you're out. Yeah. And so when people, the layman, as you would say, looks at markets, they seem to be mad and crazy. 1 minute, this time a year ago, like last September, sterling was going to go to parity, and Don't know exactly where it was this time a year ago. Now it's 125 again.
Yeah,
Right?
yeah.
So we have all this hype and all this noise, and it's just, it's not right or wrong. It's just the way markets work. So what I'm trying to do with my behavioural finance is say, look, I think there are three tribes in markets: the short-term leverage trader, the medium-term risk managing asset allocator, and the long-term investor. Now, the long-term investor, if you want to succeed as a long-term investor, you need to take account of what those other two people who are much more active than you are actually doing in markets. Yeah. So it's trying to understand the needs and requirements of those three different pieces and putting them all together. And when they're all singing from the same hymn sheet, you get very powerful moves in markets, whether it's up 2021 or down 2022. Right now, this year, there's been no clear direction, so we've got a very choppy market. And so those are the three types of markets that we have. Strong trending up, strong trending down, and choppy sideways. Now, the two trending markets, that's actually about 70% of the time, right? So what we want to be able to do is to be in the ones that are working and out of the ones that aren't. Yeah. And in the choppy ones, we basically want to carefully risk manage so that we don't get whipsawed, so we don't get fooled by too much of the noise, and hopefully retain a positive return. I don't care in a choppy market if I don't go up and down exactly like the market does, because that's not really what I'm trying to do. I'm not trying to track a market. I'm trying to deliver a long-term return for long-term investors.
And is there any interplay between the two aspects of the fund, the thematic and the behavioural finance, or should we think of those as quite separate buckets?
No, there is interplay. I mean, it basically, the factors and the themes are both different ways of looking at global equities. So, but in a way, what I'm trying to do with this is almost like for years, people have had a 60-40 fund where they've got your equity risk and then they're dialing it down with some bonds. My view is, I think there's a better way of doing it. And so actually I'll take more equity risk with my themes because they're kind of longer duration, as they would say. So therefore they're more sensitive to changes in the discount rate. They tend to have a higher beta, tend to have more high growth because they are long-term thematics. And I don't dial that down by having bonds, but I dial it down by having a more stable, almost index approach to global equities, but not just buying global equity index. I'm basically saying there's different ways to look at global equities, whether it's through momentum, whether it's value, whether it's growth, or whether it's quality. And my way of balancing which ones I have is the same process that I have balancing which themes that I have, which ones I think are working, which ones I think are not working at any particular time. I do it it's a pretty systematic way of analysing the expected risk return from either the factors or the themes, but I keep them as separate baskets. And most importantly, what I'm trying to do to kind of use an expression from kind of when people talk about funds, I'm trying to cut off the left tail. I'm trying to cut off the downside risk as much as I can. So think of the way I invest as being like I'm investing with conviction. So if I've got conviction in this theme versus that theme, I might have equal conviction in all of them. And that might be I'm all in for everybody, or it might be actually I'm all out for everybody. And if I've got no conviction that things have got a good risk return profile, I'm not going to force the money to work just because I'm trying to track an index. I'm very happy to have it essentially in money market funds in cash. But if I've got lots of conviction, I'm going to be heavily exposed to the things that I think are working. So I have a basket that does that for themes, and I have a basket that does that for factors. Now, the cash component of those two baskets is observed separately. I don't swap between the two, but generally, if I've got no conviction anywhere in themes, it's unlikely I'm going to have very much conviction anywhere in other markets. But it does vary, but what I'm trying to do is just put in a discipline. So I'm saying to the long-term investor, look, you don't have to worry, should I be in value now, or should I be in momentum, or should I be in quality? I've got that for you. And if I don't want to be in any of them, we've got cash. And now, of course, nowadays, cash actually delivers you a return as opposed to no return at all. Same with the themes. Not every player is on the pitch at the same time. Sometimes they're on the bench. Doesn't mean I don't like the theme, but it can mean either that it's run ahead very, very aggressively and my risk return requirements suggest that's actually, let's take some profits, or as we've seen for some of them, I can see, look, I really like this long-term thing, but right now they're running into some technical or market-driven headwinds. So for example, China, the China internet theme, it's a great long-term theme. The companies are delivering, but right now there's been a lot of other reasons why there's been disinvestment in China to do with risk management, to do with effectively institutional investors declaring aspects of China uninvestable. So if you're facing that headwind, there's no point saying, but this is a great theme, we must stick with it. I can say, well, actually, my system allows me to take it off the table, but I'm not ignoring it, I'm watching it, and if I think that forced selling has gone, then I'm happy to start to add back in again. So again, it's a disciplined approach, trying to take account of the different kind of headwinds and tailwinds that either themes or factors get.
One thing that I wanted to ask was there any particular advantage in terms of launching the fund out of Asia, given Tosca has actually got many different locations? Why did you pick Hong Kong as a place to launch the fund?
The reason we launched it out of Hong Kong was partly because I was already living in Hong Kong, but really because Toscafund is an alternative asset manager, but it acts and thinks like a family office. In that sense, they have a lot of alternative funds available. There are a lot of stuff that is in private equity or private credit or hedge funds. And that matches what a lot of family offices have. But what Toscafund didn't have as an offering, which is also something that family offices require, is the kind of the large liquid global equity component. So the reason I got together with Toscafund is that what fitted into their product suite fitted in it because actually they're a multi-family office. If they think like a multi-family office, therefore, okay, we've got the alternatives, but what about a proper way or a better way as we think of doing global equities? Now, Asia in particular is where the growth of family offices is really, really powerful. And Hong Kong is, to my mind, the centre, going to be the sort of financial centre that essentially is linking China mainland with the rest of Asia and through it the rest of the world. So in a sense, we have a product which is designed for a family office. It is the way we think a family office should approach global equities. There is a huge pool of family offices in Asia who are looking to diversify. They're looking to diversify away from their core business, that funds the family office. Many of them are looking to diversify away from China or indeed Asia, so therefore are looking for global equities. Many of them are essentially looking to diversify away from illiquid products, because essentially they'll have a lot of property, they'll have a lot of money tied up in their own physical business. A lot of them very successfully been participating in the private equity and private credit world for the last 10 years or so. So we just saw it as an opportunity that there's a large pool of hopefully like-minded people who are saying, actually, this fits our profile. We like the way that you're approaching global equity. You're not just buying an index. You're not just tracking a benchmark. Why would we want to track a benchmark down? We're happy to actually give up a little bit of the upside in order to be able to have some protection on the downside. But we don't want some fancy derivative-driven overlay quantitative thing that we don't understand. We want something that is clean, transparent, decent pricing, that isn't unnecessarily complicated, isn't pretending to do something. And ultimately, we want to capture the upside of equities, but we don't see why we have to participate in all of the downside. We're not expecting a miracle, but I'm now talking to a lot of the CIOs of family offices or multifamily offices, and this is a proposition that we think works for everybody. I mean, it's where I'm putting my money, it's where Tosca's putting their money, because we are thinking like family offices as long-term investors. So it's really saying, if you're not constrained, if you're not forced to track an index, and if you're not trying to compete against the benchmark all the time, then we think this is a better way of doing it. So if you want to join, then invest alongside us. I think that's probably what I mentioned before. Is the way we're not in the business of asset gathering. We're in the business of asset managing. Yeah. We're managing them for us, and if you want to come along, that's fine. We'll charge you a reasonable fee to join in. But we're doing it anyway.
And finally, particularly with one eye on the October volatility, how are you positioning the fund for the final quarter of 2023?
Well, obviously, we are now actually feeling more comfortable. We've had this. July was caught a lot of people by surprise because it went up by 5-6%. And there are a lot of people who are cautious. I'm happy sitting in cash. Oh, I missed that. So you actually went into August with the retail consumer in the US, particularly very, very bullish before they went on holiday, only to find it all went down again in August. August never has very good seasonality. The worst seasonality is actually September. And so the way I look at the markets generally in terms of the positioning is always keep an eye on the March and the September options expiries, because that's where a lot of the derivatives unwind or a lot of positions are put on. So obviously last week was the September options expiry. It went okay. There's nothing terrible about it. So that removed a level of unknown risk for me. Was there something about to blow up into that options expiry? Because you never know until it's happened. It looks like that was fine. There's an awful lot of cash on the sidelines. That cash, I believe, is going to start to deploy. And I think two things are going to happen in Q4. One of which is cash that was really supposed to be in bonds is going to start nibbling away at bonds. Now you've got 4.3% yield on the 10-year. People are saying, well, if we think the Fed is... on a 12-month view, the Fed is going to say we're done with tightening, at which point the bond market rallies 10%. Yeah. So therefore, why not be in there now? I think that's definitely a move that's going in there. And if that supports the bond market and seems to put a floor under the bond market, we thought it was there at 4. Now it looks like it's there at 4.4. If the bond market seems it stabilizes and starts to rally, that is very helpful environment for equities. Secondly, a lot of that cash has sat there in institutional. So the long-term investor is sitting there thinking, well, I'm all in. The institutional investor is sitting there heavily in cash and underweight equities. And the question mark is going to have to be, how am I going to generate a real return? Now the inflation is going to be 2 to 4%. How can I generate a real return in the future? Yeah, I can get a 4% yield on bonds, but that's not going to be enough. I've got to go somewhere in equities. What am I going to buy? Well, actually, I'm going to buy into the thematics. I'm going to buy into Asia. I'm actually going to look at China and go, okay, well, if these distressed sellers have gone, they are making an awful lot of money, and there's an awful lot of good companies there. So I can't ignore it, much as politics would like me to do so. I'm looking at what's happening to the oil price. It's up through $100. Why am I not exposed to the energy companies, and so on and so on? So essentially, we are in the global equity fund, we are biased towards towards the themes things like digital security. Mm-hmm. We're liking the global energy at the other end of that. We really like our robotics and automation. There's some profit taking that, but that still remains a very powerful story. Really like, I think we talked about before, what I call the Buffett trade. 3 years ago for his 90th birthday, Warren Buffett borrowed money at 0.4 and then bought a whole bunch of Japanese trading companies. That remains a great story. It's a great way of playing global growth. So I think the concern that we had over the summer, I know this sounds silly, but I don't like it when a market goes up 5%. That's not normal. And so funnily enough, it comes back down 3%. I'd rather have a nice 1 and a bit every month, thanks very much. And on balance, I think, we think that the fundamentals are okay and they're fine, particularly actually in Asia. particularly in the global commodity super cycle, isn't going away. The innovation side of things, the robotics side of things, the whole AI, I'm finding it easier to play it, ironically, through the digital security that you will need to go with AI at the moment than to try and find a particular stock. So we're confident, more confident, shall we say, that there are a few banana skins out there, but you never know. And October's we have had some bad Octobers in the past, but generally, I think it's been the September problems. The problems have been flagging up in September that cause a bad October, and I don't think we've got that same situation this year. But we shall. The hindsight portfolio always outperforms. So.
Mark, thank you so much for coming back on. It's been
my
really
pleasure.
Fascinating to hear the interplay between that and behavioural finance and the themes. We look forward to catching up in due course and see how the year pans out, and then how the fund's doing next year. Thanks for coming on Vantage.
No, pleasure. Thank you for having me.